In 2026, hedge fund leverage sits at record levels, and enormous positions, like the Treasury basis trade, rest on models that assume markets stay liquid and correlations stay low. The archive's sharpest test of that assumption is 1998, the most credentialed fund ever built, and the 4 months that nearly broke Wall Street. This is the archive of LTCM. This is an archive of the 1998 collapse of long-term capital management. Documented market history only. Not a forecast, not investment advice. Chapter 1. The Dream Team. Long-term capital management launched in 1994 under John Meriwether, Salomon Brothers' legendary bond chief. Its partners included Robert Merton and Myron Scholes, who won the Nobel Prize in Economics in 1997, while at the fund. It was the smartest money ever assembled, and for 4 years it returned around 40% a year. The strategy was convergence arbitrage. Find tiny mispricings between related securities and magnify them with enormous leverage. Individually, the trades were conservative. The leverage was not. 25:1. Leverage. 4.7B capital, 125B positions, 1T. Notional derivatives. Chapter 2. The assumption. The models rested on history. Correlations between markets were low, liquidity was permanent, and extreme moves were vanishingly rare. And because the returns were famous, the trades were crowded. Half of Wall Street had copied them. Chapter 3. August 1998. On the 17th of August 1998, Russia defaulted on its domestic debt. Capital fled to safety everywhere at once. Every spread LTCM owned widened simultaneously, moves the model scored as 10+ standard deviations, effectively impossible. Diversification vanished exactly when it was needed. Leverage did the rest. Capital fell from $4.7 billion toward $400 million in weeks, while the positions still exceeded $100 billion. Effective leverage exploded as the equity shrank. 4.6B, lost in under 4 months. Chapter 4. The Rescue. The Federal Reserve Bank of New York convened Wall Street's chiefs and brokered a $3.6 billion recapitalization by 14 banks on the 23rd of September. Not taxpayer money, but a central bank orchestrating a private rescue because a forced liquidation of $100 billion in crowded positions threatened everyone in the room. The Fed also cut rates 3 times that autumn. Markets recovered quickly, and the episode was filed as proof that the backstop works. That lesson was carried with interest into the following decade. 14 banks, 3.6B private bailout brokered by the NY Fed. Chapter 5. The lessons. The record connects this episode both backwards and forwards to Newton in 1720, intellect is no defense, and to 1987 and 2008. Crowded, leveraged positions unwind mechanically. The models mistook a calm decade for a law of nature. Chapter 6. The pattern. The pattern the record shows. 1. Exceptional minds plus returns attract exceptional leverage. 2. Models assume liquidity and low correlation until stress. 3. One shock correlates everything. Leverage does the rest. 4. The backstop prevents collapse and trains the next cycle. This archive does not predict the fate of today's leveraged trades. It documents what happened the last time the smartest models on Earth met a week their history had never contained. The archive stays open. This is what the historical record shows.